McDonald's doesn't just sell burgers and fries. It quietly operates like one of the world's smartest real estate companies, using food as the bait. When people think about McDonald's, they imagine fast food, golden arches, and billions of burgers sold every year. It feels obvious to assume that most of McDonald's money comes from selling meals, but the truth is far more interesting. Behind the scenes, McDonald's has built a business model where real estate, not food, is the real profit engine. The burgers keep customers coming in, but the land beneath those restaurants is what truly makes McDonald's powerful. To understand this, we need to go back to how McDonald's expanded in the first place. When Ray Kroc joined McDonald's in the 1950s, the company was struggling to scale. Selling burgers alone was not creating consistent, predictable profits. Franchisees were opening stores, but McDonald's headquarters didn't have strong control over them, and revenue was unstable. Kroc realized that if McDonald's depended only on food sales, it would always be vulnerable to rising costs, competition, and thin margins. Food is a low-margin business. Ingredients fluctuate in price, labor costs increase. Competition forces prices to stay low. Even when a restaurant is busy, profit margins are often small. Ray Kroc understood that selling food could bring volume, but not long-term financial security. What he needed was a way to generate stable, recurring income while still expanding fast. That insight led to one of the most important strategic shifts in business history. McDonald's would stop thinking of itself as just a restaurant chain and start acting like a real estate company. Instead of allowing franchisees to own or rent their own locations, McDonald's would control the land and buildings themselves. Here's how the model works. When McDonald's wants to open a new location, the company carefully selects prime real estate. These are high-traffic areas, near highways, busy intersections, shopping zones, and growing neighborhoods. McDonald's either buys the land outright or signs long-term leases at favorable rates. Then it builds the restaurant on that land. Once the location is ready, McDonald's does not usually operate the restaurant itself. Instead, it leases the restaurant to a franchisee. The franchisee pays McDonald's two major things: a franchise fee and ongoing rent. This rent is often much higher than what McDonald's itself pays for the land or building. The difference between what McDonald's pays and what it charges the franchisee becomes profit. This is where the magic happens. Even if food sales slow down, McDonald's still collects rent. Even if the franchisee struggles, McDonald's still owns the location. The real estate becomes a long-term asset that grows in value over time. Land in busy areas almost always appreciates, especially over decades. In many cases, McDonald's rent income is more stable and predictable than food revenue. Franchisees may have bad months, economic downturns may affect spending, but rent checks still arrive. This creates a powerful financial cushion for the company. Another key advantage is control. Because McDonald's owns the land, it has enormous leverage over franchisees. If a franchisee doesn't follow company standards, McDonald's can enforce rules more strictly. Losing a lease is far more serious than losing a supplier contract. This ensures consistency across thousands of locations worldwide. Over time, McDonald's built a massive real estate portfolio. The company owns or controls land and buildings in some of the most valuable commercial areas on the planet. These properties were often purchased decades ago, at prices that seem unbelievably low by today's standards. As cities expanded and traffic increased, the value of these locations skyrocketed. While competitors focused only on expanding menus or cutting costs, McDonald's was quietly accumulating assets. The food brought customers, but the land created wealth. This model also makes expansion safer. When McDonald's enters a new market, it does not rely entirely on predicting food trends. It relies on real estate fundamentals. If the location is good, the property itself holds value even if the restaurant fails. In the worst case, McDonald's can replace a franchisee, rebrand the location, or sell the property at a profit. Have no long-term asset if they fail. McDonald's, by contrast, often owns the most expensive part of the business, the land, while outsourcing the daily operational risks to franchisees. Franchisees handle staffing, food preparation, local marketing, and day-to-day management. They take the operational risks. McDonald's collects rent, royalties, and fees. This structure allows McDonald's to grow globally without taking on the full burden of running every restaurant. Financial reports consistently show how powerful this is. A significant portion of McDonald's operating income comes from rent and franchise-related revenue, rather than food sales. In many years, real estate income contributes more to profits than company-operated restaurant margins. Even when McDonald's sells food, the margins are often lower than the margins on rent. Rent has minimal ongoing costs. Once the property is acquired and built, maintenance costs are relatively small compared to the steady income it generates. Food, on the other hand, involves continuous expenses. This real estate strategy also protects McDonald's during economic downturns. During recessions, people may cut back on dining out, but franchise agreements still require rent payments. McDonald's may offer temporary relief in extreme situations, but the underlying model remains strong. Over decades, this approach has turned McDonald's into something closer to a real estate investment trust with a fast food brand attached. The restaurants act as highly visible, cash-generating tenants for McDonald's own properties. What makes this strategy even smarter is branding. The McDonald's brand increases the value of the real estate itself. A McDonald's location signals high foot traffic and commercial viability. Other businesses nearby benefit, which further increases the value of the area. This creates a feedback loop where McDonald's presence strengthens its own property value. In some cases, McDonald's owns the land under restaurants that have been operating for 30, 40, or even 50 years. The food menu has changed many times, but the land keeps appreciating. The burgers are temporary. The real estate is permanent. This model also explains why McDonald's is so selective about locations. The company doesn't just ask whether people will buy burgers there today, it asks whether the land will be valuable for decades. McDonald's real estate arm is so central to the company that it has dedicated teams focused solely on site selection, property acquisition, and asset management. These teams think like investors, not chefs. Generates value even beyond McDonald's own operations. If needed, properties can be redeveloped, subleased, or sold. Few restaurant chains have that level of flexibility. This is why McDonald's can remain profitable even when food trends change. Health trends, competition, and consumer preferences affect menus, but land in prime locations remains valuable. McDonald's is not betting only on taste. It is betting on geography. In simple terms, McDonald's sells burgers to customers, but it rents land to franchisees. The customer-facing business is food, but the company-facing business is property ownership. That difference changes everything. Many people assume success comes from selling more products. McDonald's shows that owning the right assets can matter more than what you sell on top of them. The food brings traffic. The traffic justifies the location. The location creates wealth. This strategy has been studied by business schools for decades because it flips the traditional restaurant model upside down. McDonald's is not just a fast food company that happens to own land. It is a real estate company that uses fast food as its operating system. When you walk into a McDonald's, you're not just stepping into a restaurant. You're stepping onto one of the most carefully selected pieces of commercial real estate in that area. Every fry sold there supports a much larger machine working silently in the background. So the next time you see a McDonald's at a busy intersection, remember this. The burgers may feed customers for a few minutes, but the land feeds the company for generations.